A Fibonacci extension and trend-based Fibonacci time zone are some of the best tools, since this is a situation with limited price action after the IPO when price drops towards new record lows. While the main events of interest at the interval lines will be bearish continuations and bullish reversals, there can be some focus on bearish reversals. This is most apparent with the 1.618 interval after a minor bullish retracement. The downtrend lines mostly enhance the identification for events of interest concerning bearish reversals and bullish continuations. With an early uptrend under significant bearish conditions, the main focus is on support around the 0.786 extension level to hold and preferably produce an upswing by late March at the 1.382 interval. Otherwise, a bearish continuation is more likely to begin April. Bullish conditions emerge and progress from late March to May, when a downswing is missed by interval lines. Again, this is normal. Not all swing points can be covered. Towards early August, there is a similar situation back in the support range around the 21 price range. No bullish conditions emerge to reverse back up by the 2.618 interval, and the rapid drop quickly shifts attention for potential support at the next extension level around 18, but still around the time of the 2.618 interval. When approaching the trend line intersection with the 0.382 interval of a new, larger trend-based Fibonacci time zone, attention is directed at a bearish continuation or bullish break. When the bullish break started over the trend line before reaching the 0.382 interval, short-term attention switched to resistance being cleared near 22 by early March. Then, when an immediate downtrend filled in the gap, the main event turned out to be a bearish continuation right into March. After that, continued volatility had attention directed at whether new lows would establish under the trend line by the 0.618 interval. When a neutral to bullish stance began, attention then changed again to clearing resistance by the 0.618 interval. Since clear swing points were less frequent starting in late 2019, a shorter base trend was not very useful, as it compressed intervals too close together to clearly identify distinct intersections of interest. When the chart is more range-bound with slightly more frequent swing points, a moderate base trend targeting an interval through the March 2020 lows produced a useful set of intervals. During more range-bound trading phases, attention is primarily focused on when the range could end, and not necessarily which direction the range will end with a breakout. During such rapid movements near an interval like the 2.618 interval, attention rapidly changes like in other examples. In this case, attention is first directed at clearing resistance under 25 before 2021. When this doesn't happen, attention is directed at a potential upswing around support at 22 by the start of the new year. Similar to other examples, a new base trend and retracement based on older price action are chosen to target a major landmark. In this case, the target is to run an interval line through the double bottom from late 2020. The main interval line of note is the 1.382 interval at the second upswing of the double bottom. This, along with other intervals running through clear swing points and continuation breakouts, provides a valid and reliable set of intervals during the continuation of the larger uptrend.